Hi friends, Simon here from InformedTrades.com. In today's video, we're going to provide an introduction to dividend stocks, what they are, and how investors and traders can use them as a part of their strategy. Let's get started. Okay, key points. We'll start by defining what dividend stocks are, and then we'll take a look at how dividend stocks generally have performed over time relative to other types of stocks. Okay, what are dividends? Dividends are the part of earnings that companies give back to investors. Now, that's generally true. In some instances, you might have a company that's unprofitable, but is actually borrowing money and using that money to issue a dividend to shareholders. But the general idea is that these companies are earning money, and they're sharing these earnings or giving back these earnings to their shareholders as a part of the deal. So, whenever the company announces earnings, or they'll have a dividend schedule where every month, every 3 months, every 6 months, every year, they're going to issue, they're going to look at how much they've earned and issue a part of that, a percentage of that, to their shareholders. That's the basic idea behind dividends. So from this perspective, you can see that dividends have two ways where you can earn money. You can earn money through the income stream, through the dividend that you're going to be getting, the piece of the profits that you're getting on a fixed basis, on a fixed frequency, as well as the potential share price appreciation. So if you have a stock that's issued, that you paid $50 for, and it gives you a $1 dividend every 6 months or something, $2 a year. That's money you're getting. And then, of course, the share price could move. Maybe the share price we're in a bull market, maybe the share price will go to 70, 80, 100, or whatever. So there's two ways you can sort of earn money with dividend stocks. Now, with dividends, there's that income component. So whenever you're talking about income strategies, two things will almost always hold true, which is the idea of compounding and the idea of patience. So what a lot of investors do with dividend stocks is gather those dividends, gather those, share of profit payments that may occur on a fixed frequency every 3 months, 6 months, a year, whatever, and just continue to reinvest those. So in that example before, where a stock is priced at $50 or you paid $50 for it, you're getting $1 dividend payments twice a year as a share of your share of the profits. You sort of continue to reinvest that. And then that's how the real, it's a slow path. It's going to take quite a bit of time, but that's how you really make a whole bunch of money. And it's the same idea with bonds, where you're reinvesting coupon payments and a lot of fixed income investment type of strategies. Okay, the other thing to note is that, so that's the income part of it that we just talked about, but the share price of dividend stocks, they tend to actually outperform non-dividend stocks. So really, in addition to getting the income, the share price actually tends to go up more than the share price appreciation potential of non-dividend stocks. You can see that on the chart here. This is from 1972 to 2012, so a 30-year period, contemporary financial system, post-Bretton Woods Agreement. You can see dividend payers in the S&P 500 have considerably outperformed. And also, what's not shown in this chart is also that the drawdown is less. So not only are the stock prices appreciating to the upside more, but they're also declining less. Meaning, so you don't have to worry about them being ultra volatile and having a big drawdown that you have to deal with. These dividend stocks are more stable and are appreciating more than non-dividend stocks. However, with that said, I still want to emphasize that dividend reinvestment is still the primary means of capital accumulation for shareholders. So basically, if you invest in a large cap company like an Exxon or something, GE, IBM, and you invested in them, and we're looking at a data set here of 1980 to 2004. So it's 10 years ago, but I think this concept is still going to hold true, where if you compare capital appreciation to meaning the amount that the share price went up relative to the amount of money you got from just taking dividends and buying back those shares, it's the dividend reinvestment that's generating more wealth. And this particular data, this slide that you're looking at now, like I mentioned, is large cap companies from 1980 to 2004. But in general, that concept, I think, is one that's really worth bearing in mind. Dividend reinvestment is, the key. It takes a lot of time, but over time it generates considerably more in profits. And that's about it for our introduction to dividend stocks. In subsequent videos, we're going to delve into more details about how dividends are paid out, the frequency, find stocks that are really good dividend stocks. We'll talk about all those things. Any questions you have, anything you want to add, join us at informedtrades.com. You can also help us make better videos by making a contribution at informedtrades.com/donate. And of course, liking this video on YouTube, sharing it on Facebook, Google+. That also helps us get the word out, helps us grow, and helps us continue educating as well. Best of luck in your trading and investing, and we'll see you next time. Take care.